First off, happy 4th of July to my American listeners. I hope everyone has a happy and safe 4th of July with fun and barbecues and drinking. Hopefully not too much drinking. Definitely do not drink and drive. No drunk texting if you can avoid it. And hopefully not too much family drama. So today, July 3rd, today the Dow, the S&P 500, and the Nasdaq Composite are all at all-time highs. And yet on the mainstream financial media, I had on Fox News briefly, I had on Fox Business, I checked some other channels, and here are these mainstream media journalists totally giddy over the fact that on the Fed meeting, let me look up the exact date here. I have the Federal Reserve's website up. I normally don't go to the Federal Reserve's website. It's federalreserve.gov. So the people out there who are saying that, the Federal Reserve, this is the part of the Federal Reserve that hides behind the government for protection because they have a .gov on their website. And even though they're a private corporation or really a banking cartel, they're kind of public and private, each one when they need to be. They walk that line and they jump across whenever they need protection from the other one. So they're just a cartel. The Fed meeting is July 30th and 31st. So these journalists, and I'll use air quotes, were giddy. And you know what? They weren't even financial journalists. They were giddy about the rate cuts and how that could make stocks higher. So I guess they must have nice, cushy salaries and nice stocks in their retirement accounts because they were super excited how stocks are at an all-time high now and how they think stocks are going to go even higher with the rate cuts. But why do we need rate cuts if we have the greatest economy ever? Why do we need rate cuts if asset prices are already high? Okay, the reality of the real economy, the reality of the global economy versus the asset prices, especially in the U.S., it's two different realities. And not only do we have all these central banks like pumping massive amounts of monetary inflation and credit into the system, but we also have flight capital that's come out of China, flight capital that's come out of the European Union, especially with massive amounts of negative yields in the European Union coming to the U.S. And that's why, besides these central banks, which are the European Central Bank, the Bank of Japan, the People's Bank of China, those are the ones who have been doing the massive amounts of QE, the most QE since 2015. The Fed has done officially nowhere near as much QE as those other central banks. And yes, the Fed works with the Bank of Japan, it's coordinated, same thing with the European Central Bank, but the Fed hasn't done any of this themselves. The U.S. capital markets have just benefited from all this flight capital coming to the U.S. And this brings me to something that, as an Austrian school economist, some of you guys don't like the Mises Institute or the Austrian School of Economics, that we are getting more evidence that we are in the early stages of the crack-up boom. Now, this doesn't necessarily mean hyperinflation throughout the global economy, although I just took a picture on my Twitter, a comparison picture of Charmin Ultra Soft. I bought a 12-pack, 12 rolls of Charmin Ultra Soft a couple months ago, and it said 12 of our rolls equals 54 of everyone else. Now, 2 months later, it's down to 48. It's down to 48. So 330 toilet paper squares versus in the past only 2 months ago, now down to 286. And so that's like, I calculate out the number 286 divided by 330. That's about a 13% loss in purchasing power just from Charmin Ultra Soft if you were buying it and then you rebought it. And on top of that, the price now is actually, I think it's been going up at about $1 every year or so for the last couple years. So the crack-up boom, we have asset prices. There's a good argument, I've been saying this for a while, that asset prices, especially American asset prices, are in hyperinflation mode. And people will be like, Jason, the price-to-earnings ratio of stocks are not that high. Well, there's financial engineering, there's trickery. It's an illusion with the price-to-earnings ratio. Why? Because with a lot of these large-cap stocks, there's been $5 trillion in share buybacks in the last decade, and a lot of that has been done with debt. So you see on a large cap stock that, they have a 2%, a 1% or 2% dividend yield and a 20 price to earnings ratio or a 25 price to earnings ratio. It doesn't look like hyperinflation, Jason. Well, that is because their other metrics are showing signs that of drastic overvaluation that's even more grossly overvalued than 1929, 1999, 2007, which are the other really big stock market bubbles in US history. So the price to sales ratio is, I believe now, for a lot of large cap stocks in the US, it is 50% higher than what things were, I think, in 1999. I heard that on a McIlvaney Weekly commentary in the last couple months. I could go back and check it. So just because the price to earnings ratio, the executives of these corporations know that the average person, the average analyst covering these companies, or the average investor, the average retail investor, is only going to look at the price to earnings ratio. And that's how a lot of these large corporations get away with financial engineering. So their companies are not growing revenues, sometimes at all. Sometimes their revenues are contracting violently. And how do they grow earnings? Well, they leverage the balance sheet with debt. And the executives think, well, I'm not going to be here when this blows up. I'm going to be gone in 3 years because we beat earnings every single quarter. I triggered my stock options package, and it doesn't matter. So this is the reality of the situation. It is very sad. So some people are like, well, if there was really more inflation, the interest rates would reflect this, and we would have more signs that there was really inflation. That is BS, okay? The governments with financial repression are manipulating interest rates down. The debt on Italian government bonds should not be cheaper than the yield on American government bonds. And in general, it's all these yields on European government debt are all being driven down. And if you're looking for yield, most bond investors, first off, unless you're Stanley Druckenmiller, most bond investors are only looking for yield. They're looking for some income, most of them. However, now with the scheme that these governments are playing with financial repression, with artificially manipulating interest rates, using QE and other tricks to lower interest rates, interest payments on their debt, now you have a situation where they're causing the principal value of bonds to go up, and they're driving yields down. So this is not sustainable. I don't know how much longer it can go, but people are going to lose faith in fiat, hopefully lose faith in digital debt-based fiat currencies. It will probably start on the periphery. I think there is a lot of flight capital coming in from emerging markets, from China, from the European Union, into asset prices in the US. If you studied financial history, this is what happened prior to the October 1929 crash. That was really one of the first times the whole globe was global. There was a global economy and capital was flowing freely. Was prior to the October 1929 crash. So after World War I, and the companies, a lot of these countries, they didn't set the price right on the gold standard, and a lot of these countries, because they underset the price on the gold standard, they did crazy amounts of stupidity with monetary policy and credit. And the Fed created an enormous artificial boom. There were other countries that did it. There were hyperinflations from a lot of other countries after World War I, prior to the U.S.'s Great Depression and the October 1929 crash. So if you want to do the research on that, there's a lot of research available. But I found a interesting interesting audio clip from Dr. Mark Thornton. This was an interview in 2014. It's on the Mises website. I'll attach a link if you want to listen to it later. But I'm just going to play about 2 minutes of this really quick.
So what is the crack up? What is a crack up boom?
Oh, it's probably one of the scariest economic phenomenon in modern human history. And just suffice it to say is that a crack up boom involves a hyperinflation where prices in the economy accelerate so fast and people just don't want to hold on to their money. Just hold on to it for minutes and then spend the money until you get to the point where no one is actually willing to accept money and money becomes worthless. And, and the value of your currency can depreciate by 1 trillion%, basically, as money becomes valueless and society cracks up, essentially.
Okay, how would it play out? Let's say we had a crack-up boom. Well, we've got one going on right now in Venezuela, don't we? And there's another one going on in Turkey. Iran had one. Argentina's undergoing one. Or would we call these to this point that they're crack-up booms?
Well, they're possible crack-up booms, and I think the order you listed them with Venezuela, the leading candidate, I think that's probably a good way of doing it. Crack-up booms are rare, but under fiat monetary systems, they're always a possibility. And basically, it involves the central banks of a country, printing up too much fiat money. Now, this can go on for a long time. People may not realize that the government is devaluing its money, and anytime that you get more of a good, of course, it's subject to diminishing marginal utility, so you have less value for it. And so, as the government adds and the central banks add more and more money into the economy, we eventually place a lower value on that additional money, so it has reduced purchasing power, which means the prices of goods and services in the economy start to rise. And then once people get the wind of this idea that their money is depreciating, that their wages are not being able to purchase the same basket of goods and services that they're used to purchasing, then they want to get rid of their money as quickly as possible. And when people change their demand for money and they reduce their demand for holding money, that speeds up the spending process, which puts even more upward pressure on prices in the economy, and it makes it more difficult for the government to achieve their goals through inflation, which is basically being able to spend money without any cost to themselves. Well, then the process of inflation ratchets up into hyperinflation, which means that the purchasing power of the dollar or whatever currency we're talking about is reduced by 10 or 20% a month. And once you get into that phase, things can quickly spiral out of control, basically. It becomes very difficult for a central bank to get control back once people lose faith in a currency, and that's why you see these things happening very, very quickly. And so when you have a situation like Venezuela, they're already into the hyperinflationary stage where the value of their currency is, say, falling by more than 10% a month. So they're very, very much prone to going into this crack-up boom mode where you have appearances of prosperity because people are spending the money so fast.
Okay, if you want to listen to the rest of this, I'll just attach a link. There's another 8 minutes or so of this with questions and answers back and forth. But some of the key takeaways there are that the people are starting to realize their purchasing power is not good. The scary and perverse part of this is the Keynesians, the people in power at the central bank, the academic PhD Keynesian economists do not want you to save. They do not want you to hold cash in the account. What do you think that negative interest rates are for? Negative interest rates are to try to force people in Europe, and I don't know if Japan has negative yielding debt, but European banks actually charge you to put money there as checking or savings account at the bank. At least some European banks do. They don't want you to save money, or at least at the bank they don't. They want you to spend it. And even if that means going into debt, more credit is good. That's how Keynesians view things. So all these major economies are all in different degrees of bankruptcy and stupidity and, heading towards basically the abyss. So I have a interesting Ludwig von Mises quote here. He says, "There is no means of avoiding a financial collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion or later as a final and total catastrophe of the currency system involved." I think the Keynesians, they want a catastrophe. Ben Bernanke was hoping that he was hoping that he could do all these crazy things, and he trapped the Fed with the QE, and Janet Yellen didn't want to start raising interest rates and selling off the balance sheet. I think she did one token raise, maybe two. It was a small amount. And, the Fed was still trapped. They are still trapped. They were trapped years ago. They cannot reduce the balance sheet. And now you have a situation where Jerome Powell was hiking rates as Fed chairman, and he almost broke the junk bond market, and he almost broke the corporate bond market. And that's why these central banks, the major ones, are worried about interest rates rising. That's why they're trying to cap rates. And this goes back to the Carmen Reinhart captive audience, her comments. So Ludwig von Mises, I have some long articles here about crack-up booms and hyperinflations. Most people aren't aware of this, but Ludwig von Mises was alive in Austria as Austria was close to like a hyperinflation. So I think, depending upon different accounts, he may or may not have stopped it and been given credit for it. But he was way ahead of his time. He's in the academic profession of economists. He's not given really any credit at all. And I think there's a new rap battle that's coming out with von Mises. I think the guy who did Hayek versus Keynes, the movie producer or TV producer, I think he just raised the money on a Kickstarter campaign. So we're going to see a new Ludwig von Mises economic music video soon. So the asset prices are going crazy. The real economy is bad. But the key takeaways from the Dr. Mark Thornton little clip that I played for a couple minutes for you guys was loss of purchasing power. And we're seeing that in the real economy. Now, it's not hyperinflation, it's stagflation. But there is a lot of monetary inflation and credit that's been created, and it's working its way throughout the global supply chain. You have wage increases in certain cities and states here in the U.S., and different countries are demanding higher wages. So all those things for producers of goods, they go into the input costs. And, if oil prices rebound, that'll mean even more higher input costs, and that'll be passed on to the consumer. So it's going to get worse before it gets better. The velocity of money, someone brought up velocity of money in the comment section. There's plenty of velocity of money in the asset prices. In the real economy, the consumer, I don't think, is spending nearly as much here in the U.S. I think the consumer is starting to cut back. There's a lot of context. I just got a newsletter from someone who's worked in the financial industry for 20 years. He worked at Goldman Sachs. He's a hedge fund guy. And it sounds like even him and other people are starting to do bad now. So he called himself medium rich. And he's like the medium rich people who were affluent and comfortable, but not like filthy rich. They're not doing as well now either. So they're getting hurt by stagflation and taxes. Print your problems away. It worked for Zimbabwe. Well, when you have the dollar, though, the reason the U.S. has been able to get away with it so long is the U.S. has an enormous military which enforces the dollar. And on top of that, the U.S. has been able to export a lot of those digital dollars out of the country, and a lot of that has gone into, a lot of the monetary inflation and the credit has gone into asset markets. But you also have a situation now where the U.S. haven't even done the rate cuts yet. They haven't even restarted officially the QE. But you already have tons of monetary inflation from Japan, the European Union, which is continuing QE, I believe, and then also China. And there's a lot of flight capital that has left China and probably gone into stocks. One of my sources, said that money is still leaving China and going into like funds in the Caribbean and other banking areas. And that money is going into real estate all over the globe. And then on top of that, now you have all these problems in Hong Kong, right? With all the protests. Well, you know what? The Chinese government is not going to give up trying to pass those extradition laws. They may wait a couple months or something like that. There's a lot of stuff going around the internet that the whole government building in Hong Kong, that was like a fake. So there was like People's Liberation Army people dressed up as protesters that sacked the government building. I don't know if it's true or not, but there's a lot of stuff going around Twitter alleging that stuff. But there is going to be, if things do get bad in Hong Kong, and I'm sure this is already happening, there are a lot of very affluent families in Hong Kong that, by the way, they escaped mainland China, the Chinese Communist Party or Communist Party of China. They escaped mainland China to go to Hong Kong to escape socialism, to escape, no free speech and all those things. And they've lived in Hong Kong a long time, and those rich families in Hong Kong, they're going to be moving their money out. You're going to see a lot of capital flight out of Hong Kong probably in the next, I would say, it's starting now. I don't know the exact amount, but it's going to be ramping it up probably in the next 6 months or so. Okay, well, I just wanted to give you guys an update on the craziness with the stock market and how the media is saying how we need these rate cuts. It's just ridiculous. Now, the rate cuts will help the over-leveraged U.S. corporations, the junk bond companies, the over-leveraged corporate debt, but the average person on Main Street, it's not going to really benefit. You're not going to see the rate cuts. Are not going to benefit your credit card rates or your ability to borrow on your mortgage. They're not going to affect any of these things. The person on Main Street will not benefit from these rate cuts at all, unfortunately. But this is how things are going, and this is why there's a lot of populist politicians making a lot of crazy promises, and a lot of people, a lot of Americans, and we're also in Europe with the Yellow Vest protests, a lot of people are getting truly desperate. And, you know, the socialism argument does well for desperate people. When people are doing really, really bad financially, someone coming along and promising them an extra $1,000 a month, even if $3 trillion or more per year has to be printed, even if you have to tax 100% of the rich. Actually, the funny thing is, if you tax 100% of the rich, it still wouldn't pay for all of these programs that these Democrat politicians in the debates are promising. Okay, they could take 100% of all the rich people's money here in the U.S., and by the way, that would collapse a lot of markets. There would be tons of flight capital leaving the country. Businesses would be sold or stop producing if they attempted that. And because I've run into people recently in the last couple weeks, socialists claiming that if rich people are taxed at sky-high levels or even 100%, that it would fix things here in the U.S. And I'm telling you, you know what? If you jack the taxes up that high, they will just take their money and leave. It happened in France. France tried to tax, I believe, French residents, the really wealthy people like Gerard Depardieu and some other very rich French people, like 70 or 80%, and they left. Didn't they give up their French citizenship? They're not in the country anymore. So these politicians think that they can just tax everyone, increase property taxes, layer on taxes, and that no one's going to leave their state. Look at Illinois. Illinois is a disaster. Chicago's a disaster for many different reasons. But financially, the state of Illinois is a complete and total disaster. And their politicians, Republican and Democrat, stupidly think that they can fix the financial problems of their state just by increasing property taxes on working class families and middle class families who've owned homes there for a long time, and then layering on either new taxes or increasing existing taxes. And you know what? For most people, it's probably not going to work. People are going to say, I can't afford to live there anymore, I'm going to leave. Okay, guys, that's it for right now. I think I provided you guys a little bit of update, and I'm going to work on some other interviews after July 4th, some big ones. Okay, bye for now.